So does higher interest rates hurt the stock market? Because that's what you need to know. Because if it doesn't, what are we worried about? If it doesn't, we should worry. This is the Fed. They're expecting 3.8. I think that's very optimistic. I think interest rates are going a lot higher. But interest rates have gone pretty much higher across the curve. When I say across the curve, long-term bonds have gone up in interest, which means they've gone down. And short-term bonds have gone up, which is good for structures. And we're going to talk about structures today, Carl. I know you own structures. And structures have gotten better because interest rates have gone up. And I know you've got structures coming due, so we'll talk about that. But anyway, the dollar's been rallying. Now, all my money that I have it in my portfolios, which you guys are in, because I stand behind what I invest in. But I do have a chunk of money in the dollar. Because if interest rates go up, guess what happens to the dollar? I had a client yesterday say to me, Dom, isn't the dollar going to collapse because of all the spending and the deficit spending? I said, well, first of all, Japan is 200 times debt to GDP. We're about 120. So Japan is not blowing up. They're fine. That's number one. So do deficits matter? We could argue that. But remember, would you rather be in the dollar right now? Would you rather be in the euro? Would you rather be in the Russian ruble? Would you rather be in the Chinese renminbi? I think I'd rather be in the dollar. And that's why when interest rates rise, people rush to the currency that has the highest interest rate. So dollar's not going to collapse, guys. We are the best looking horse in the glue factory. Yes, you could argue with all this deficits. You could argue that, hey, isn't money going to be worthless if there's a lot of money in circulation? Well, the Fed's pulling money out of circulation, by the way. That's called demonetization. The Fed buys bonds, that puts money into the system. If the Fed sells bonds, that takes money out of the system. And the Fed buys mortgages, they buy treasuries. They're selling bonds. That means that's going to make bond prices go down, interest rates go up, and money come out of the system. And that tightening is going to hopefully slow the economy to bring down inflation. So that's why everybody's kind of freaking out. So anyway, I don't know if you guys know who this guy is. Sir. He was a sir. I should put sir by it. That means he's been knighted by the... You know what's interesting? I don't know if anybody reads history. Jack, I know you like history. He woke up, he would drink a bottle of scotch before noon. We call that an alcoholic. Okay? I think he was an alcoholic. The key to the future is study the past. And he didn't invent this quote, but I use it because he said it a lot. And here's why we need to look at the past. Because the question is higher interest rates going to cause this market to go down, and should we be concerned about our portfolios? Well, what I'm looking at here is I'm looking at inflation and I'm looking at interest rates. And what this chart shows us for in the back there, Carlisle, it shows us that when interest rates are rising, when inflation is rising, which is the black line, the Fed funds rate usually has to rise above it to stop it. Now, inflation is about 8.5%. It came down a little bit. That's why the market kind of bounced the last 3-4 weeks. But if inflation stays here, the Fed's got to raise interest rates to 9 or 10%. Well, is that going to crash the market? I don't know. Let's look at history. The key to the future is study the past. Let's do it. 1977. The Fed funds rate was as low as 4.62. By the end of the year, it was 6.5. And guess what happened? The market dropped to 15, ended up down 11.5. Okay, started raising rates, looked like the market's going to be affected. Interest rates don't go higher. In 78, interest rates went from 6.8 to 10. Market went as high as 14, low as 7.5, ended up flat, 1%. Now, 79, Paul Volcker raises interest rates from 10 to 15%. Market's up 12% that year. What? Check this out. 1980, Paul Volcker walks into Jimmy Carter's office. He says, Mr. Carter, I'm raising interest rates to 20%. Did anybody buy a home in 1980? Carlisle, did you guys remember that? Was it ugly? Ugly. I'll tell you guys a true story. I was a young man on Wall Street. I think I started in 83. And in those days, I worked for Merrill Lynch, essentially. And in those days, I remember we'd go in, we'd have a morning meeting. And the way it would work is, they'd have Dunkin' Donuts because Starbucks didn't exist. They'd have donuts and the coffee, and you kind of walk in, and I'd sit in the back because, I was your age, and I'd sit in the back, and every day they would tell you what you need to sell. That's the way. I don't think it's changed. Merrill Lynch now, they give a 1. That's what they want to buy, and that 5 is that's what you sell. So anyway, I remember it's like it was yesterday. The guy gets up and he goes, okay, today, guys, we have $50 million in 30-year treasuries at 15% interest. Bearer bonds, which means no tax, means you clip them, you go to the bank, you get your interest. 15% a year for 30 years. And whoever sells the most tickets, ever sells the most bonds, gets 2 tickets to the Yankee game behind home plate. And I'm on the phone, true story, I'm on the phone trying to get people to buy these 15% bonds that are guaranteed by the U.S. government for 30 years. Now you would think, oh my God, you must have made a ton of money. I couldn't sell them. I get on the phone, and I in those days they give you the yellow pages, and it was this big, the Manhattan yellow pages. And of course I picked restaurants because I like food. I'm Italian, I'm calling out these restaurant owners. Hey man, I've got some treasuries. Could you buy 5? Could you buy 10? Because they're $1,000 increments. So could you buy 10? Could you buy 20? I'd make 2 points. So if I sell 20, I'd make $200. So, and that would be $20,000 to the client. But they make a long story short. They hang up the phone. I mean, they go, no, interest rates are going to be, 22% in a month. They're going to be 25% because remember, we think linear, right? Interest rates go from 5, 10, 15, 20. God, I'm not going to buy your bonds because interest rates are going to be higher tomorrow and my bonds are going to lose money. I couldn't sell them. Today you would be like, oh my God, back up the truck. Could you imagine? Could you guys imagine if you could buy a 30-year treasury at 15%? It blows me away. So anyway, it's just interesting that the data is telling me initially it is a shock to the system, but the market does not seem to be affected. And you go through, it stayed at 20% the next year, the market was down 10, and then it started coming down, the market was down 15 and 82. But what's interesting is there was not a correlation between rising interest rates and the stock market crashing, and that's really what you need to understand, is when I started doing the data, I told my team, I told my quants, I told my head trader, Pat, I said, I just think people are a little bit over their skis. Now, this is a great chart. And everybody, and Carlisle in the back, you can't see this chart. But what this chart is, it overlays all the times when the Fed started raising rates. And this is now right here. And of course, the market's not down 18, it's bounced. But a year later, this line is kind of zero line. A year later, when the Fed started raising rates, it looked like the market was back at all-time highs. That's what this data tells me. And if you combine this data with this data, and then you think about what this lady said about good and bad inflation, I don't know that we should be so concerned about rising interest rates. Now, I'm not saying that China doesn't or Putin doesn't drop a nuclear bomb somewhere and the market's not going to crash because of that.